At some point in almost every growing business, the owner hits a wall. There's too much work for one person. Jobs are taking longer than they should because you are doing everything yourself. Opportunities are being turned down because there is no capacity to take them on. And the answer seems obvious. Hire someone. But then the second thought arrives, usually pretty quickly. Can I actually afford it? And for most business owners, that question does not have a clear answer because nobody ever has shown them how to work it out properly. So they either hire without really knowing the numbers and hope it works out, or they hold off indefinitely, stay overloaded and watch the business stall because they never had the capacity to grow it. Both of those outcomes are avoidable, and today I want to show you exactly how to answer that question with confidence before you make the commitment. Because hiring when the business cannot genuinely support it is one of the fastest ways to turn a cash flow problem into a crisis. But waiting too long to hire when the business is ready is one of the most common ways business owners cap their own growth. The difference between the two outcomes comes down to understanding one thing clearly. Does your margin support the cost of an additional person? So hi, I'm Jen Richardson. I'm the founder of 123 Financial Group. We work with small business owners across trades, construction and the service industries. And the hiring question is one of the most common decision points we help business owners think through. So today I want to give you the financial framework for making this decision confidently, not based on gut feel, based on the numbers that are actually sitting in your business right now. Before we talk about whether you can afford to hire, you need to know what hiring actually costs. And this is where a lot of business owners get caught out. The salary or the hourly rate is the number everyone focuses on. But the real cost of an employee is meaningfully higher than that. So let me break it down for you. Superannuation. As an employer, you're required to pay superannuation on top of wages. The current rate is 12%. This is not optional and it is not included in the wage. It is separate cost on top of the wage. Payroll tax. So depending on your total wage bill and the state you operate in, you may be liable for payroll tax. In New South Wales, the threshold is currently $1.2 million in annual wages before payroll tax applies. So for most small businesses, this does not bite immediately, but it is worth being aware of as the business grows. Workers' compensation insurance. Every employer in Australia is required to hold workers' compensation insurance. The premium is calculated as a percentage of your wage bill and varies by industry. Trades and construction sit at higher premium rates than office-based roles. This cost is easy to overlook in the hiring calculation. Leave entitlements. A full-time employee accrues 4 weeks of annual leave per year. That leave has to be paid when it is taken or paid out when the employee leaves. On top of that, they're also entitled to 2 weeks of personal or carers leave. Again, they have to be paid when they're not working, so they're not bringing money into the business and you are incurring a cost. And it is a real cost that needs to be factored in, even though it does not hit the bank account every week. Onboarding, training and management time. A new hire is rarely productive from day one. There is time invested in training, supervision and management, particularly in the first 3 to 6 months. That time has to be costed even though it does not show up as a line item. So when you add up all of this cost, the rule of thumb is that the true cost of an employee is approximately 20% to 25% higher than the base wage or salary. So if you're hiring somebody at $65,000 a year, the real cost of the business is closer to $78,000 to $81,000 once super, insurance and leave entitlements are included. That is the number you need to test your margin against, not the wage, the total cost. So there is a straightforward way to test whether your business can support an additional hire. It involves 3 numbers that you should be able to pull from zero in about 10 minutes. So step number 1 is to calculate your current gross profit margin. Run your profit and loss report in Xero and find your gross profit. That is revenue minus direct cost. Divide gross profit by revenue and express it as a percentage. For example, if your business generates $600,000 in revenue and your direct costs are $380,000, your gross profit is $220,000. Your gross profit margin is 36.7%. That gross profit is what covers your overheads and it produces your net profit. It is also what needs to cover any new wage costs. So step number 2 is to calculate what the new hire will cost as a percentage of gross profit. So take the full cost of the hire, including superannuation, insurance, and an allowance for leave. In the example above, let's say that comes to $80,000. So $80,000 against a gross profit of $220 means the new hire will consume 36% of your current gross profit before that person has generated a single dollar in additional revenue. That is not necessarily a reason not to hire, but it is a number you need to see clearly before you make the decision. And step number 3 is to work out what additional revenue the hire needs to generate. Here is the question that matters most. If this person is a revenue generating role, how much additional work do they need to bring in or complete before they pay for themselves? So using the same example above, if your gross margin is 36.7% and the hire costs $80,000 fully loaded, you need approximately $218,000 of additional revenue at that margin just to cover their cost. That is before any net profit improvement. So ask yourself, is that achievable? Is the work there to support it? Is the capacity of the business genuinely constrained by headcount? Or is it constrained by something else like pricing, systems, or lead generation? If the hire is a support role rather than a revenue generating one, the test is different. The question becomes, does this role free up enough of your own time to allow you to generate additional revenue that exceeds the cost to the business? Or does it reduce overheads or errors enough to justify the investment? Either way, the discipline is the same. You need to quantify the expected return before the commitment is made, not after. So before you decide whether to hire, there is another question worth working through. Should this person be an employee or a contractor? This is a question I get asked constantly, and it matters because the financial and legal obligations are very different. An employee works under your directions, works set hours, uses your tools and equipment, and cannot subcontract the work to others. You pay superannuation, hold workers' compensation insurance, and manage leave entitlements. The relationship is ongoing and you have ongoing obligations. A contractor operates their own business, can subcontract the work out to someone else, provides their own tools, and invoices you for work completed. You pay the invoice. You generally do not pay super directly, though there are circumstances where the contractor supply rules can apply. You do not manage leave. Contractors are often more flexible and lower cost in the short term, but there are 2 things to be aware of. First one is the ATO has clear rules about what constitutes a genuine contractor relationship versus what is actually employment in disguise. If someone is working exclusively for you, using your equipment, working your hours, and you control how the work is done, the ATO may deem that person an employee, regardless of how you have labelled the arrangement. The consequences of getting this wrong include back payment of superannuation and workers' compensation and potential penalties. The second thing is good contractors are expensive. The lack of leave entitlements and super obligations is often reflected in a higher hourly or day rate. The cost difference between an employee and a contractor is frequently smaller than people expect. Get advice on which structure is appropriate for your specific situation before you commit. This is exactly the kind of questions a conversation with your accountant should answer. So even when the margin test says a hire is affordable, there is a timing reality that catches businesses off guard. Wages go out every week or fortnight. Revenue from the additional capacity that hire creates often takes weeks or months to arrive. A new employee starts on a Monday. Their wages are due the following Friday. The work they complete this week will be invoiced at the end of the week. Payment arrives in 30 days. So in that first month, the business has paid 4 weeks of wages before a single dollar of new revenue has landed. Depending on the size of the hire and the current cash flow position of the business, that gap can create real pressure. This is not a reason not to hire. It is a reason to plan for it. Before you bring someone on, make sure the business has enough cash buffer to cover at least 6 to 8 weeks of their fully loaded cost while the revenue cycle catches up. If the business does not currently have that buffer, that is not a permanent barrier. It is a timeline. It tells you what needs to happen financially before the hire is made, not that the hire is wrong. A simple way to think about this is the hire is right when both tests are met. The margin supports the cost on paper and the cash flow position supports the timing in practice. So before you make a hiring decision, I want you to work through these 6 questions. If you can answer yes to most of them, the business is probably ready. If several are no, you have clarity on what needs to change first. So question number 1 is, do I know my current gross profit margin? If the answer is no, start there. You cannot test whether a hire is affordable without knowing what the business is currently producing. Question number 2 is, have I calculated the full cost of the hire, including super, insurance, and leave? Not just the wage, the total cost. That is the number to test. And number 3 is, can I clearly articulate how this hire generates a return? Whether it is additional revenue, freed up capacity, or reduced errors, the expected return should be quantifiable before you commit. Question number 4 is, does the business have 6 to 8 weeks of their cost in accessible cash? Not in receivables, not in the form of revenue that is yet to be invoiced, accessible cash. That is the buffer that covers the timing gap. Question number 5 is, have I considered whether this should be an employee or a contractor? Have you had that conversation with your accountant so the structure is right from day one? And question number 6 is, capacity actually the constraint? This is the most honest question on the list. So before hiring, ask whether the business is genuinely constrained by headcount or whether there are other issues like pricing, profit leaks, or systems that need addressing first. Sometimes the answer to feeling stretched is not a hire. Sometimes it is fixing the underlying structure so the existing capacity works harder. Hiring, of course, is one of the most significant financial commitments a small business owner makes. Done at the right time with the right structure is a decision that unlocks the next stage of growth. Done too early, without the margin to support it, it is the decision that puts the business under sustained financial pressure. The difference is not luck, it is preparation. It is knowing your numbers before you make the commitment, not after. And it is exactly the kind of decision your accountant should be helping you think through before you sign anything. So here is the question to sit with. If you are thinking about hiring right now, can you answer all 6 questions on that checklist with confidence? If yes, the business may well be ready and the next step is getting the structure right. If there are gaps in those answers, that is not a reason to shelve the idea. It's a roadmap for what needs to happen. And of course, if today's video has prompted you to take a proper look at where your business stands financially, I've created a free tool called the Profit Engine Scorecard. There's 15 questions. It'll take you about 10 minutes to complete, but it covers your financial clarity, your business structure, and whether your margins are strong enough to support growth, including the decisions we have been talking about today. The link is in the description. Download it and go through it before you make any major commitments. If you are at the point of thinking seriously about hiring and want someone to sit down with your actual numbers before you make the call, that is exactly the conversation we have at 123 Financial Group. We work with small business owners in Newcastle and across Australia. The clarity call is in the description and it is a straightforward conversation. There's no pressure and no pitch, but it is about how your business is sitting and whether the numbers support the decisions that you are considering. It is important to remember that the information in this video is general in nature and it does not take into account your personal or business circumstances. Employment obligations, including superannuation rates and payroll tax thresholds, are subject to change. So please seek personal professional advice before making any hiring or employment decisions. Hiring should be a growth decision, not a panic decision. And when you make it at the right time, with the right structure, and with the numbers on your side, it is one of the best investments a business can make. Give this video a like if it helped and subscribe, because next week we're talking about the 3 financial systems every small business owner needs in place to run smoothly and scale without chaos. Your business should support your life. So I'll see you in the next video.